The next two types of risks are inherent risk and control risk, which are assessed only at the assertion level, not at the financial statement level. Financial statement level risks, recall, impact inherent risk or control risk for multiple assertions, but under the new Canadian auditing standards, the auditor does not assess inherent risk or control risk at the financial statement level. At the financial statement level, we assess the overall risk of material misstatement, which is a function of financial statement level risks and inherent risks and control risks at the assertion level. At the assertion level only, we can express the risk of material misstatement for each individual assertion as RMM equals IR times CR. As I mentioned earlier, this relationship does not hold at the overall ARM level because overall RMM for an audit is more than simply a function of just IR and CR. But you can keep this equation in mind when you are assessing the risk of material misstatement for individual assertions. So, first we have inherent risk, which is the risk that an assertion is susceptible to material misstatement prior to considering the effectiveness of any relevant internal controls. In other words, is there anything about the nature of an assertion that makes it inherently more risky or less risky than average? For example, consider the inherent risk of the valuation assertion for a tangible asset such as a building versus the inherent risk for the valuation of an intangible asset like a patent or trademark. In general, it's tougher to value an intangible asset than a tangible asset because you can't do things like inspect its physical condition or check for a market price of similar intangible assets, which are both procedures you can usually use to value a tangible asset like a building. As a result of these differences, the value of an intangible asset is more prone to material misstatement than the value of a tangible asset. Note here also that it is not a financial statement level risk that is elevating the level of inherent risk here. Rather, it's simply the character of the account in question that heightens the inherent risk of the valuation assertion. For another example, consider two clients. One that is on the verge of violating its current ratio debt covenant, and one that has a very healthy financial situation and is well on side of its current ratio covenant. In the first case, we have a financial statement level risk that heightens a number of inherent risks at the assertion level because of the pressure the client may feel to manage its financial statements to stay on side of the current ratio covenant. For example, they may understate the allowance for doubtful accounts in order to overstate accounts receivable and the current ratio, which increases the inherent risk of the valuation assertion for AR. Similarly, they may understate various current liabilities to achieve the same goal, which increases inherent risk for the completeness assertion of these accounts. The client with a healthy financial position, on the other hand, would have lower levels of inherent risk regarding these same assertions, all else being equal. Moving on to control risk. Control risk is the risk that an assertion is susceptible to material misstatements after considering the effectiveness of internal controls at preventing or detecting material misstatements regarding this assertion. In other words, does the client have any effective internal controls that reduce the risk of material misstatement for the assertion in question? For example, if we go back to the valuation of intangible assets example that I mentioned earlier, perhaps your client with the intangibles realizes the inherent difficulty in valuating these assets, so it regularly hires a third-party consultant who specializes in valuing the types of intangibles held by the client. This objective third-party expert significantly enhances the likelihood that the intangibles will be valued properly, thereby minimizing control risk for the valuation assertion and ultimately reducing risk of material misstatement for this assertion as well. Just to put this in the form of the equation, we had a high inherent risk for the valuation of intangibles, but because we have the objective third-party expert for evaluating these assets, we have a low control risk for this assertion, which translates into a perhaps a low to moderate level of RMM for the valuation of intangibles. Now, imagine a second client with the same inherently risky intangible assets, but who does not use outside experts for evaluating these assets, instead relying on its own less experienced staff to handle the evaluation duties. For this client, we have the high inherent risk, we have high control risk as well, which translates into an RMM for the valuation of intangibles that is high. So even though we had the same high level of inherent risk for the valuation of intangibles across these two clients, we end up with a lower RMM in the first case because of the reduced control risk related to the use of outside expert consultants to value the intangibles. So that's just a quick little example to show you how this RMM equation can work at the assertion level for coming up with overall assessments of RMM for individual assertions. So I hope these examples help you distinguish between inherent risks and control risks at the assertion level. The first kind, inherent risks, have nothing to do with the effectiveness of the client's internal controls. We're looking more at the susceptibility or the inherent nature of risk associated with a particular assertion. And then in the second case, for control risks, we bring into account any relevant internal controls that may prevent or detect material misstatements regarding the assertion in question. And we can use the RMM equals IR times CR equation to come up with our overall assessment of RMM for each individual assertion.